obviously we're looking at support material 3. Having spoken about the tax tables again, remember you're using the 2017-2018 tax tables, not the current ones that we have from the last budget speech that just took place in Feb. The unit here is looking at support material or study unit 3, and this is different types of taxpayers. So last week we spoke about a taxpayer. We get two types, like broad groups. Do you remember what they are?
Individuals and I think companies.
Yes. Okay, so we called the one natural, that would be like you and I, and then companies would be juristic. That was the two that we get. So those are the two types of taxpayers that exist. In South Africa, it makes no difference which you are. You can be a natural person or you can be a juristic person. Both will have to pay tax. And you pay tax according to the legislation, and the legislation is set out in terms of the Income Tax Act. There are other forms of legislation, other acts. I mean, you get acts for everything because that's set by government. Remember, just to paint a bit of a revision picture from last week, we spoke about government and their role. Government's role is to provide public goods and services to the people in the country. Okay, that's what they're required to do. Government needs resources to do that. So what do? They go and they create SARS, which is a separate institution. SARS has its own commissioner, and SARS is responsible for collecting tax from you and I and everyone else in the country. Also taking external parties such as non-residents into consideration. So it doesn't matter if you're a non-resident or a resident, it makes no difference. So long as you are earning a form of income, you are going to have to pay some form of tax. And we need to now look at, well, how are they going to apply the tax system to various types of taxpayers. Last week and the week before it was introduction. So in the first week, we saw lots of different types of taxes. We saw VAT, we saw excise duties, custom duties, we saw transfer duties, we saw estate duty, donations tax. There's such a lot of different tax out there that applies to us as taxpayers. And this chapter is not looking at the tax, it's looking more at how do different people get taxed. So now when looking at taxpayers, there are certain benefits for being an individual and there are certain benefits for being a company. Okay, we need to look at what are the benefits of all these different taxpayers, and then we need to choose the ones that make our lives most, let's say, easy in terms of not having to pay too much tax. So you do need to know what the characteristics are. You'll probably recall in the assignment last week, we spoke about what makes an SBC, what makes a micro business. All of that we'll cover tonight. You'll see the slides on it, and then you'll know how to identify whether a business can fall in that category or not. So listening to what you've shared with me, you run a photography business as a private company because it's registered with the CIPC. So having said that, I do think that you would probably fall under one of the other groups of taxpayers, such as an SBC or a micro business. And you will see later that that will actually benefit you as an individual, because you did say last week that you are a taxpayer in terms of having a tax number, but you're not too familiar with how the system works, but you are obviously learning more and gaining more experience as well from that point of view. So tonight I'm just going to share more information that comes straight out of the study guide and the SARS legislation. I tend to use the legislation quite a bit. You'll see as we go, because the legislation is set in stone. So whatever SARS tells us is true and accurate, I mean, that's correct. Obviously, textbooks, depending on what year you're using, those things change every single year. So buying a textbook for tax every single year can be quite a schlep for some of the students, but it's just how the system or this module works. Unfortunately, with a module like tax, things change every single year because we have a budget every single year, and there are always certain things that come out in terms of changes in legislation, and they might be minor or they might be quite big. Something as simple as VAT. VAT is now 15% instead of 14%. VAT didn't actually change much, it's just the rate. But now all the textbooks are going to have to change for next year because now the new rate is 15 instead of 14. So things like that, minor changes. So just be aware of that. And that's why when I look at past papers, it's very difficult for me to show you past papers that I've done previously with other classes, purely because that information isn't really relevant now, because that information was based on prior tax tables. So I will always use the most recent stuff that you are going to have to use. So for example, I'm helping you now with Tax2601. I am going to be doing the past papers according to your tax tables. So a lot of the theory stays the same. Obviously some calculations differ and change, but generally things are pretty much the same in terms of applying the theory. The only thing that does change is the rates and the tables. That's the only thing. So when looking at my notes here, you'll see I talk about the different tables or brackets. So if you fall under a specific tax bracket, you pay a certain amount of tax. Before we get there, there's 3 questions here for you to consider. The first one, what are the 4 main forms of ownership? That you should know from management subjects, maybe even accounting, maybe some finance. We talked about 4 main forms of ownership. So can you give me what they are?
The forms of ownership, they're sole traders,
Good.
partnerships, companies. I don't know if closed corporations, I can put
CCs, CCs are still a form of ownership. You just can't register new ones. So if you have an existing CC, that existing CC will continue forever.
Yes, sir.
Yeah, so we still refer to it as a form of ownership, just not a new form of ownership. So if I had to go start a new business tomorrow, I wouldn't be able to register a CC. I would have to either choose company, okay, or partnership or sole proprietor. That's it. Unfortunately, those are the only 3 options that we have in this country in terms of doing business for profit. Okay, obviously you can, if you wanted to, start an NGO, okay, non-government organization, or an NPO, non-profitable or non-profit organization. So that also is a form of ownership, but obviously those non-profits, those NGOs, they actually reap quite a lot of benefit in terms of not really being taxpayers, because they kind of fall slightly outside of the scope of that, because remember, they're more in terms of social change and upliftment. So training kids, it could be cleaning the environment, it could be recycling, it could be the SPCA in terms of caring for animals or children. It doesn't really matter, but the point is, ownership here is going to be looking at businesses that make a profit and that generate income. That's what we're looking at. So all those businesses that we're going to be looking at tonight are businesses that are based on income. So for example, your photography business would be a form of ownership that we could look at here as a taxpayer, and then we'll decide on, well, which table are you going to fall under? Are you paying according to an individual? Are you paying according to a company? Are you paying according to an SBC or a micro business? We need to see what the requirements are before we can decide. And that's what we're looking at tonight. Next thing, do owners have choice? Do they?
I'm inclined to say no, so because depending on the type of business ownership, or rather the business that you run, depending on what you've registered, that's the one that you're probably, I suppose that's the tax, those are the tax implications that will fall on your business. 100%. So you don't have a choice, really.
Brilliant. That's perfect. So choice is correct in terms of having started the business. So if we rewind to the day that you wanted to create the business, and we then gave you a choice, you could choose between any of the different forms of ownership. But once you've chosen, then you need to comply with the tax that's applicable for that form of ownership. So you're right. Okay, the choice is just initially when you decide, and then later on, it's not a choice, it's compliance. Okay, you have to comply with what you've chosen, and also businesses grow. So you might start as micro, then you might go SBC, and then you might go company, SBC, and then you might go big company. It all depends, but obviously you have to comply. So you'll comply with the legislation when you're very small, You'll comply with the legislation when you're a bit bigger, and then you'll comply when you're massive. Okay, either public or private, depending on the situation. Is there a best form of ownership? There never is. Right, best is just what's suitable and what makes the most sense currently when making a decision. Right, there's no perfect answer. Okay, so I mean, you can go out there in the real world and you can seek and try find many different opportunities. None of those opportunities are going to be perfect. Right, every opportunity out there is going to have some advantages and some disadvantages. You need to find the one that best suits your need and your requirements in terms of what you are wanting to choose. That's the key. It's like when last did you go on a date? You know?
Whoa.
It's like choosing a girlfriend to go out with.
Yeah.
That's kind of what's it about. Is there the perfect woman in the world?
No.
No. You might think someone's perfect, and there might be someone who's close to perfect, but she's not perfect. So here we're looking at the best form of ownership. Obviously, ownership in terms of that would be finding someone that you actually want to marry one day.
Yes, sir.
Okay, but best is subjective because there's a lot of opinion in that as well. Because you might think, well, that woman is incredible, and someone else might not, but she's your best fit or match in terms of having all the qualities that you like and that type of thing.
Yes,
All right,
sir.
so just keep that in mind, that taxpayers, it's just a form of legislation that requires us to comply with in order to reap certain benefit, okay, to get to a specific point, which is complying with SARS. Okay, that's why I've put that note there. Best is relative. Right, relative meaning, well, you might think that girl's attractive, someone else might not. You might think her personality is so great, someone else might not. It's relative. Okay, that's the nature of relativity. Okay, opportunity is the same. Okay, some opportunities are great, some aren't so great. You need to find the one that best suits you and what you're trying to achieve. Alright, and that's why when looking at this, we need to look at that, pros and cons. That's so important.
Yes.
Right, and I've seen that come out quite a bit in past papers. Right, they talk about micro and they talk about SBC, and they tend to test the requirements quite a bit because I think they want to test understanding. Right, in terms of, well, if you're a taxpayer, could you take advantage of the legislation in terms of not having to pay as much tax as some of the other businesses if you fall under a better bracket? When I say bracket, I mean like classification. So
Yes.
companies pay tax at 28%.
Yes,
That's
sir.
a flat rate. It's been 28% for quite some time now. But in terms of the actual SBC and micro, those companies can still be companies but pay tax at a lot lower in terms of rate, in terms of having to recover more money from SARS before having to pay it over. So if a company generates R1 of income or revenue, right, of the rand, 28 cents of every rand is going to go to SARS in the form of companies tax. And now that can be quite problematic for smaller businesses. Right, so like imagine you're running a small business and you're going to have to pay 28% on everything from the first rand that you earn. That can be quite challenging for businesses. And what is government's role? Make the country better for all its citizens. So if government wants to do that, another way of doing that is by offering certain types of taxpayers certain benefits or almost like inverted commas rebates that they can make use of so that it makes their lives a bit easier. Okay, because it's tough being a sole proprietor, it's tough being a partnership, it's tough being a company even. Okay, so how does government help you as a sole proprietor partnership company? Well, they can offer these other classifications that can possibly help you in terms of not having to pay as much tax, and less money paid to SARS is more money in your business, and then your business will hopefully grow. Right, and the reason why government does that is because all businesses start out small. Okay, no business wakes up tomorrow and starts for the first day and is a multi-million rand or a multi-billion rand company. It just doesn't happen. Even the companies that are making millions and billions a year, those companies would have started somewhere. Okay, and that's always the backstory to all big companies or big organizations. All right, big things start out small and they grow over time. And that's what we're looking at here. And that's why government incentivizes small business. They give people that have the right spirit, that have the right entrepreneurial skills, and that have the guts to do it, and they give those opportunities to those individuals and those businesses so that hopefully those businesses can grow. And if those businesses can grow, then you become an employer at some point in your life, and then you would be able to employ and make a difference in those individuals' lives. Okay, because that's what a big company does. Any big company that started out maybe with one or two people. So just to talk about something as simple as Apple. Okay, starting in the garage. Okay, and Jeff Bezos, Amazon. Okay, I quite like these examples because they both started in the garage. It's quite ironic that two of the world's biggest tech companies, Apple and Amazon, actually started from the garages of people's houses back in the 2000s. It's incredible. So this is something that I'm just mentioning now because even with that, they're small businesses. I mean, think of running Apple or Amazon from a garage. That's insane. Okay, to think that it started out like that. But that's how it started. Jeff Bezos, Steve Jobs, starting it out. And then now Apple and Amazon, now they employ hundreds and thousands of different individuals across the world. Okay, and that's why government is wanting to incentivize small business in terms of these benefits. Because if your photography business grows, that's going to help the government in the long run. Why? Well, if Unam's photography business is a success, he's an entrepreneur. He is going to be making his own income, his own salary, and that's his. And then with that, if the business grows and grows and grows, this entrepreneur is then going to open up a studio and have several photographers work for him, and that becomes a benefit to the country because now SARS is going to be collecting a lot more tax.
Yes.
Think about this. Does SARS want to collect more tax from people? Of course they do. So how are they going to do that? Well, give people that have businesses opportunities to employ more people. Because now if Unam is going to hire person A, B, and C, and the business is succeeding, now you've got person A, B, and C also paying taxes to SARS. Okay, so it's a win-win situation for the government.
Yes, sir.
Right, so that's background. That's what the textbook talks about. Why do we do certain things? How do we have such a lot of different types of taxpayers? It's all because of growth, generally. Okay, so number one, here's it. Different types of taxpayers. I've summarized the key points, stuff that's important to note and remember from a sole proprietor point of view. Right, so let me ask you this. Did you start your business as a sole prop? Or did you start it immediately as a registered company?
No, well, sole proprietor because it took maybe a year or two before it actually became a business and a company.
Okay, perfect. That's a good answer. So everything generally starts as a sole proprietor or trader, where it's one individual with an idea, with a passion, with a purpose, with something, and they're going to go out there and create a business and do business. So when looking at this, just remember some basics. This you might even have covered in other subjects. Management, I think, tends to cover quite a bit of the background around different forms of ownership, and they tend to take you a little bit deeper from a management point of view. I don't know how much management subjects you've done, but you might or might not have delved deeper with each of these forms of ownership. From a TAX2601 point of view, you don't have to go very deep at all. Alright, and the reason for that is the only thing deep about this is, well, the question mark, how much? That's all we need to ask.
Yes, sir.
Okay. For us, as a taxpayer, the big question is how much must I pay? That's what we have to ask. So if I'm looking at the different types of taxpayers, the first one is the easiest to start. Okay, there's no separate legal entity. You can start this tomorrow if you wanted to. And there's no separate taxpayer, meaning who pays the tax? The owner.
Yes, sir.
They have to declare their income. they have to pay their tax. That's how it works. And that's why I've put the word owner there in capital letters. The owner is the business. They're one and the same. You don't distinguish between the business and the owner. They're one and the same. If I talk about the business, I'm actually talking about the owner. If I refer to the owner, I'm actually referring to the business. There's no distinction between the two from a tax point of view. From a tax point of view, the business is the owner is the business. They just want to know how much income did you earn over the last 12 months.
Yes, sir.
And that's what we're going to be looking at in terms of the tax liability calculation. Right, last week when we were doing some calculations in the assignment, I told you that previously, the week before, that I gave you a structure to remember, which was income, then less deductions and allowances. Right, then you have to add your capital gain, and then you get your taxable income, and then after that, you then work out this, which is the liability. Right, so there is a big difference between taxable income and tax liability. The liability is how much you actually pay to SARS. The taxable income is how much you earned and the amount that's taxable. Taxable means SARS is actually going to tax that amount. Right, so not all income is taxable. Later on we'll learn about income that's not taxable. Right, and that's actually the best form of income. You can earn so much of that income and it's not even going to be taxed. So there are ways to structure your finance as an individual, as a company, to make sure that you end up paying the least amount of tax. Notice I said least amount of tax, meaning you're still paying tax, but you're just paying less of it. As long as you're not breaking any of the rules, as long as you're following the rules, as long as you're complying with the legislation set by government, you're never ever going to get into trouble.
Yes, sir.
Okay, so there's the tax table for an individual. Right, how much do we pay in terms of maximum income tax? There's the answer, 45%. How little can we pay? 18%. Right, so you are going to have to decide on which category or bracket you fall under as an individual running a business. Right, it could range anywhere between 18% all the way up to 45%. As a taxpayer, you will fall under one of those brackets. Right, and when I say brackets, we're looking at taxable income. Taxable income is how much do you earn in terms of receipts and revenue and income. Okay, and remember it's accruals and receipts. SARS doesn't care if you've received the money or not. As long as you've earned it, they'll tax you on it. Right, so it doesn't matter if you've received it or not. It's similar to accounting in terms of the accrual principle. Okay, and that's how it works. So generally, SARS is going to be taxing that income as soon as you get it, and then at some point in time, you'll obviously receive it, but that's not such a big consideration here. Bad debt is something that's discussed, I think later on. I can't remember if it was this tax module or the next one or the other one. I know one of the tax modules, it might be 1501. I don't know if you've done 1501, but you're doing 2601. 2601 is slightly different. 1501, 1502, those are more individual tax type of modules, okay, where they take this a bit deeper in terms of the individual. For us, it's generally going to be companies. Even when you look at some of the past papers, in past papers, they're not really going to be testing you about an individual, okay, as a business. They're generally testing company, okay, majority of the time. Not all the time. Sometimes SBC, micro, maybe even CC, but yeah, our income tax in terms of individuals and trust, okay, this table applies to both, ranges from 18 to 45.
Yes, sir.
Partnership, exactly the same as a sole proprietor. The only difference is, instead of having one, you've got two different individuals, A and B. Okay, and this applies to a partnership, even like a marriage, if you will. Okay, if you talk about that whole marriage thing again, girlfriend, boyfriend, doesn't matter. All right, if you form a partnership, all right, and your girlfriend is irresponsible with her spending and she has lots of debt, would you be liable for her debts?
Yes.
Yes, you would. Okay, if your partnership has created revenue, let's say your partnership has made $1 million. Okay, you and your partner are running the business. This $1 million is going to be split between you and your partner, and then both are going to have to pay tax individually. Right, that's very important to remember. So a taxpayer is someone who has to pay tax. Does a partnership have to pay tax?
Yes. No, well,
No, the
on
partnership doesn't have to pay tax.
Yeah, the partners have to.
Because they're not separate. The partners make up the business. Does that make sense?
Yes, sir.
Okay,
Yes,
so
sir.
those two go hand in hand. Sole proprietor and partnership, identical. The only thing that you need to remember is, well, normal tax must be calculated in terms of taxable income, and then you work out a liability, which is how much you actually end up paying. Right, partners have to declare their profits and losses, and that's been described in the material, the theory. Right, the study guide's actually pretty good in terms of giving you example questions. I really like the study guide in terms of practice exercises and questions. It's a bit better than the textbook. The textbook is a little bit more advanced. Some of the chapters, you don't cover all of them, so be careful with that. If you do decide to get the textbook, just make sure that you are covering what you need to cover and that you don't go overboard. Right, if you go overboard and you study that textbook from chapter 1 right up until the end, you've covered way too much. Okay, so stick to the study guide from UNISA. Follow their guidance in terms of what to study, what topics to cover, what's important. Okay, and then also follow the notes. The notes pretty much cover the same thing. Alright, so partners must declare their income. They have to. Same table applies to the partners, except A is going to have to submit their own return. Okay, we spoke about a tax return, ILP 5. Okay, that's if you're employed. If you're not employed, you're a sole proprietor, you pay yourself. It's called drawings. Okay, you draw from your business. If you're a company, then you'd pay yourself a dividend, or you'll distribute profit to the members of the CC, depending on how it's structured. Okay, or you just pay yourself a salary. Okay, if it's a separate legal entity, if it's a company, right, then you'd have to consider that. Right, but again, if I'm looking at a partnership, no separate legal entity, own return. A and B are each responsible for their own income tax return that they have to file every single year with SARS. Okay, that's something that you're required to do by law, so long as you've earned income. Okay, there is a they call it a what do they call it now? I forget the word now. Almost like a concession, if you will. A concession is something whereby I can't remember the exact criteria. Oh no, I closed the internet. Okay, but I can search for it later if you're interested. But there is criteria. If you earn a certain amount of income, but only from one employer, so i.e. a company, and you haven't got any other investments or property or anything else other than just the income that you get from the job that you have, then you would fall under that like concession, and then you wouldn't even have to register for a SARS income tax number. All of that wouldn't apply. But most people obviously have savings, investments, own other property, etc., and that's why that's not such a good idea in terms of trying to not pay trying to not submit a return. Okay, it's always a better idea to submit a return and register as a taxpayer. It's just good in terms of track record, keeping tally, and keeping your books in order, basically. Right? Because remember, SARS is part of the rule of law. Okay, if you don't follow their rules and you don't pay your taxes, you're going to get the government coming and knocking on your door to say, well, why haven't you paid us this or this or this? Or they might want to do an audit, and then you have to disclose all the information. Okay, as long as you've got the information, they can come see it, and then you'll be fine in terms of complying with what's required. Okay, so sole proprietor partnership, the partnership and the sole proprietorship doesn't pay separate tax. Who has to pay the tax? Who gets the burden? It's the actual individual. So it's the owner. It's the partners. Okay, does that make sense?
Yes, that does.
Okay. All right, now we've got a closed corporation. What is a CC? Well, it's a separate legal entity. CCs will exist in the future. They won't die. Yes. They won't retire. Okay, those organizations will continue to operate in the foreseeable future so long as they keep adding value and as long as they keep positive cash flow.
Yes,
Are they a separate taxpayer? The answer is yes. Definitely. Right, so will a CC have to pay its own tax?
Yes, sir.
Of course they will. Right, that's what I've written there. Taxed separately. Members are separate from the business. What does that mean? Well, a member is considered the owner of the business. Okay, that's the fancy word we use to describe an owner of a business. Well, in this case, the owner of a CC. Owner of a CC is called a member. Do members pay tax?
Well, on their own personal.
Correct. Good. So members are still people. Those people
Yes.
will still pay their own personal income tax, but at the same time, so will the company, so will the CC. Does that make sense?
Yes. Yes.
Okay, good. Only existing CCs will continue. We've spoken about that already tonight, so I don't have to talk too much about that again, because the because of the Companies Act. A few years back, I think it was in around 2007, if I'm not mistaken, I think the Companies Act in that year was reviewed and changed, and when it changed, they then incorporated CCs as part of companies, and that's why that fell away. So we can't actually register new CCs because at that time and in the past, generally CCs in terms of a form of ownership were almost abused in a way, in terms of people trying to take advantage of the system and avoid paying more taxes and that type of thing. So it did create problems in the past. Obviously, when there are problems in the past, then that gets fixed in the present, and now we are obviously in the future, because now we have to follow the rules around companies, sole proprietors, and partnerships, and we kind of ignore CCs because you can't register new ones. Only the existing ones exist, but they're actually treated sort of like companies. Okay, that's what I said there in the last bullet. Tax similar to companies. That's very important. Right, so I've given you the tax tables. I've literally taken this out of the document that I sent through to you. I've shown you what the tax rate is for a company. That's how much they pay. 28%. Right, the nice thing about this, have a look. Small Business Corporation, SBC.
Yes, sir.
How much tax they pay on the first 75,750?
0%.
Nothing.
Yes, sir.
Okay, nothing. Right, that's a big difference compared to 28%.
Yes.
Right, so let's do the working quickly. Right, if you earned 75,750 and you times it by 28%, if you were a company, how much tax would you pay?
75 times by 28%, you would have paid 21,210.
Yeah, that's a lot for a photographer. That's a whole nice Nikon 5D with all the spare lenses as well, hey?
Yes, sir.
Okay, that makes a big difference to a small business. Do you agree?
Yes, sir.
Okay, if you're considered a company, you'd be paying 28%. That means on 75,750, you're going to have to end up paying 21,210 prior to buying the camera. Okay, you're going to buy the camera with what you have left after you've paid 21,210. Right,
Yeah.
so you see why businesses would look at trying to comply and meet the requirements for an SBC or a micro business. Have a look at
Yes,
the
sir.
micro. On 0 to 335,000, but be careful though, this is on turnover.
Yes, sir.
Okay, so turnover is looking at something called sales. Alright, and sales is very different to taxable income. Okay, we'll look at what the differences are later. Taxable income, just to give you the short answer. Taxable income takes deductions into consideration. Okay, so if I'm paying for water and lights, if I'm paying for rent, if I'm paying for stationery, those are expenses. If those expenses are used for me to run my business, I'm going to claim that when I submit my return. Does that make
Yes, sir.
sense?
Yes, sir.
Okay, we'll learn about deductions later on in more detail. Okay, but having said that, looking at turnover tax for micro businesses, micro means very small. If you're a micro business, you don't want lots of admin. Okay, admin is a pain in the neck. I hate admin. I don't know about you, but admin is such a pain. Okay, I'd rather pay someone to do admin for me than have to do it myself because I just don't like doing it. Okay, so admin is something that is basically paperwork, kind of. Okay, like filing stuff, doing all that type of thing. So admin is something that a business would have to do if they're an SBC, Small Business Corporation. Okay? And the admin would be required because why? You're needing to work out your taxable income. Right, so would you have to keep all your receipts? Would you have to keep all your invoices, etc., etc.?
Yes, sir.
Of course you will. Right, if you're a micro business, okay, that's one of the benefits of a micro business. You'll see them talk about pros and cons, just to give you one of the advantages. If you're a micro business, you don't even have to worry about this, admin. All you have to do is just keep track of your sales. That's it.
Yes, sir.
That's what you do. You keep track of your sales. How much did I sell? Right, so that means if you sold 335,000 Rand worth of sales in terms of photo shoots, okay, and you make 335, right, yes, you are going to have to pay for fuel because you have to travel to the destination. Yes, you are going to have to buy new memory cards. Yes, you are going to have to buy a tripod. Yes, you are going to have to buy new lenses, etc., etc. It doesn't matter, whatever the case is. Okay, yes, you might have to buy other things as well. You might have to pay for a venue, etc. Doesn't matter. But all those costs you don't have to record or keep track of. All SARS is going to want to see, if you're a micro business using turnover tax, is this. How much did you sell over the last 12 months? If you sold 335,000, you would literally pay nothing in terms of tax.
Yes, sir.
Okay, absolutely nothing. So if you can show 333,000 worth of income in terms of sales, i.e. taxable turnover, you would have to pay 0 to SARS. Right, even if you make 500,000 a year taking photographs, then as a micro business paying according to turnover, you're just going to pay 1% on your turnover. Right, so
Yes.
1% of 500,000
It's 5,000, I think.
is 5,000 Rand, eh?
Yes, sir.
5,000 Rand is nothing on 500,000, do you agree?
Yes, sir.
Okay, Unam, what's 28% of 500,000?
28, it's 140,000.
140 grand. That's a lot of cameras and equipment.
Yes, sir.
Okay, you can see why certain businesses may want to use other forms of classification, because the difference between paying 5,000 turnover tax versus 140,000 companies tax is 135,000 Rand. That's the difference.
Yes, sir.
Okay, and that's what we're looking at. Okay, so let's understand this in more detail. Okay, so the first one I'm going to give you information about is the company. Let's talk about what a company is. Okay, well, first things first, you get two types, private and public. If I'm a private company, no one knows what's happening inside the business. Only the private shareholders know what's happening inside the business. Private
Yes.
means there's a level of privacy. If it's a public company, then there is transparency. Transparency meaning they have to list on an exchange, so they have to present their annual financial statements to everyone in the world because they're public companies. That's the big difference. From a legal identity point of view, they're exactly the same. They're separate. From a taxpayer point of view, they're exactly the same. They pay their own tax. A company is taxed separately, and a company will be taxed according to the various rules. Okay, so either 28% or SBC or micro, depending. Shareholders are what we call the owners of the business. Are they separate? Yes, they are.
Yes.
So do they still pay their own taxes?
Yes, sir.
Yes, they do. Right, so you can be a shareholder of a company, you can work for the company as well, then you'll be an employee. So as the company will pay its own taxes, and then the company will also have to provide the employee with an IRP5 form, and then that employee will also have to do their own tax return. Does that make sense?
Yes, sir.
Okay, perfect. Right, what is the rate? 28% is a flat rate. Flat rate meaning you get taxed on the first Rand that you earn. Right, and that's quite a big disadvantage for some types of businesses. Not all. Okay, only some. And then you've got companies tax and you've got the financial year. That can change in terms of not always having to be like 1st January to 31st December or 1st March to 28th Feb. Okay, it can be any tax year that you want. Alright, companies choose their tax year when they register the company with the CIPC. So when you registered your company, you would have been asked, what is your tax year? So what is your tax year?
1st March to 28th.
To Feb.
Yeah.
Okay, cool. So it's the same as an individual. So you've chosen to look at a tax year the same as an individual. It doesn't matter what the year is. It could literally be anything. Some businesses have year ends around September, October. Some do the December one. Some do the March or April. So it all depends. But it makes no difference. At the end of the year, at the end of the at the end of the financial year, it makes no difference. It's still a 12-month period. It doesn't matter when the period started and when the period ended. Something else to consider? Dividends tax. And this actually went up in the last budget, but we're not looking at the current information. We're looking at what was presented last year in terms of the budget speech for that particular year of assessment. 2017 to 2018.
Yes, sir.
Okay, there's the tax tables again. The reason why I gave you that is because this applies to a company. Companies can either be classified as company, 28%, income tax, SBC, or turnover tax, microbusiness. Exact same tables, same application. We'll look at it later on. Okay, big tax announcements, budget speech. This actually came from the study guide. Right, so please reference your UNISA study guide. It's a really, really good summary showing how the tax year operates. Okay, we've actually looked at it already. But so I just want to ask you currently, what tax year are we currently in?
Now we're in 2018 to 2019 tax year.
Correct, yes. As an individual, it'll be the 2018/19 tax year, so 100%. Right, and obviously, in terms of budget, when does the budget come out?
The budget comes out, in February.
Exactly. The February in the year that's going to start, correct. So, for example, we are living in the 2018/19 tax year. Do you agree?
Yes, sir.
And those rules would have been presented this year in Feb.
Yes, sir.
Okay. The test that you are going to write, the exam, is going to be using information from the 2017/18. So in other words, last year's budget speech, that's what we're looking at.
Yes, sir.
Okay, perfect. Right, so question. Do businesses like paying tax, Unam?
No, sir.
Yeah, they don't. So how can we avoid paying too much tax? What do you think?
Well, I think we could probably invest in perhaps maybe shares, perhaps have...
be careful with things like that. We're looking at a company. You can't really say companies can invest in shares. Yes, they can, but then that's treated slightly differently.
Yes, sir.
So just be careful with that.
Okay. But I think they could... can they not open up like those tax-free fixed deposits?
You're talking about something that you've seen in the media. Yeah, tax-free savings account. What is a tax-free saving account?
I tried to open one. Well, I do have one.
Yes.
It's like you paid zero tax as long as you are not depositing anything. Well, as long as you don't have money over, I think it's 30,000 or 33,000, something like that.
Yeah. I think it went up from the last budget, something like that. But yeah, it's around 30,000 a year that you can invest in a tax-free savings account, and then any growth. So if you earn a return on investment, none of that will be taxed as long as it's a tax-free investment savings. And then I think it's $500,000, 500,000 over your lifetime.
Yes, sir.
Yeah, that's how it works, correct. So that's incentives for who? Companies or individuals?
I think it's individuals.
Correct, it's individuals. Companies can't open up a tax-free savings account. All right, individuals can. Only natural persons. Yes, not juristic.
Yes, sir.
Okay, so just be careful with that. Here we're looking more at special tax concessions. There's the key. We saw it earlier. We just used an example. Paying 5,000 tax is a lot better than paying 140,000 tax. Okay, and that's what a concession is. It's allowing you to to pay a lower tax amount, basically. Got that?
Yes. Yes, sir.
Okay. This is the SBC definition in terms of requirements. What I am obviously going to refer to is your study guide. Okay, your study guide gives you the exact breakdown regarding the SBC. This is something that I took from the Act, okay, in terms of what defines it. Okay, so here I wasn't really looking at this in terms of gross income, 25 million, and less 12 12 months and 5 million. Okay, I think it was 25 million if I'm not mistaken. These things change all the time. This was taken from the Companies Act 1963 where they defined it, okay, in terms of the Income Tax Act, and they describe the SBC as gross income, okay, for a year of assessment not exceeding a specific amount. Just be careful with that amount. That amount can change year by year by year. Okay, but the basics doesn't change. None of the shareholders or members at any time during the year of assessment, okay, of the company or CC holds any shares or has any interest in equity of another company. So see, that's important. So if you are a small business owner, if you directly own shares in another company, that creates a problem.
Yes, sir.
Okay. Not more than 20% of the total of all receipts and accruals. This is looking at other than those of capital nature, and all the capital gains of the company or the closed corporation consists collectively of investment income and income. Okay, it gets quite technical. You'll see there's a nice summary somewhere. I can't remember if I've included it in these notes or if it's the next set. Let me just quickly scan. Oh no, it's the next set. Okay, you'll see it next week. When I send you Study Unit 4, you'll see I've included a summary there of the differences between an SBC and a micro business. I think I even mentioned in the assignment questions. So the recording that I did for those questions that we hadn't covered yet, I'm going to go through some of them tonight just to explain the workings behind it. But I did try and mention some of the detail there regarding the study guide and its importance in terms of summarizing those two key categories, and NB being familiar with the updated information, okay, the information that's applicable to you. Normally they tell you what that limitation is in the exam. I have seen a past paper before where they spoke about I think it was a 20 million amount that was allowable. Okay, I think now we'll have to check it. I can't remember offhand, but I think it's 25 million if I'm not mistaken. Having covered the assignment last week, I think that's what I remember seeing in the assignment was 25 million, but we can check just now. Okay, something else that we need to look at here is just the accelerated write-off, wear and tear allowances that you can make use of. Okay, so what assets will have wear and tear?
Your manufacturing, well, all of your assets that you use to run your business.
Correct. Capacity assets, basically. That's how I like to look at them.
Yes, sir.
Yeah, so capacity means buying a new camera. That's additional capacity. Buying a new laptop. Buying a new factory. Buying a new machine. Buying new equipment. Okay, those are assets. They can be movable or they can be immovable. Right, we're not going to cover them tonight. You're not going to see any of that now. Okay, you're going to see that later. So if you want to, you can make a note C later. We will look at accelerated write-offs in terms of wear and tear in a separate chapter when we look at those deductions that companies can make use of, and specifically the capital deductions, okay, the capital allowances, okay, because capital deduction, capital allowances take preference in terms of write-offs against income tax for companies because it relates to those assets, like machinery, equipment, etc. That all needs to generally be disclosed separately.
Yes.
Okay, here's the one for micro. Applicable to companies and sole proprietors. Notice, a company even can fall under this group, which is quite remarkable considering you pay 0%, 1%, and at most 3%.
3%, yes.
Can you imagine? 3% compared to 25%, that's 28%.
28%, yes.
Right, or even 45% as an individual.
Yes.
Okay, remember we saw those tables earlier. A sole proprietor would have to pay up to 45%. A company would have to pay up to 28%.
Yes.
A micro business would pay up to 3%.
3%.
Okay, it's insane how good that is in terms of small businesses and helping small businesses.
Yes, sir.
Right, and that's why, because the government is trying to grow those small businesses. So hopefully, if that small business can grow to a big business, now they can start grabbing 28% of all the income.
Yes.
Okay. What is the biggest challenge for an SBC? Or not SBC, sorry, small business?
The biggest challenge for them, I'd imagine that the biggest challenge for them would probably be getting business.
Yes. And what would you say the next challenge is?
Paying enough, probably paying tax. But then I'd say
you have to do that. You can't get around that.
Not paying it on an interim.
Kind of. You're thinking too outside the box. Let me ask you this: what do you hate the most about your business in terms of a task or something that you don't like doing?
Oh, admin.
Exactly. Okay. Biggest challenge for a small business is massive amounts of administration. Tax returns, documents to submit, paying fees to CIPC, paying an accountant perhaps to draw up the books, to draw up the financials, etc., etc., etc. If you're a micro business, do you need any administration?
No, sir.
No, you don't.
Just like me.
As long as you can show sales, that's all you're ever going to need.
Yes, sir.
Right, that's it. But now the problem with that is, can you claim wear and tear deductions?
No.
No, you can't, because you're being taxed on your turnover. You're
No,
not
it's just sales only.
being taxed on your taxable income. See, there's that big distinction again.
Yes, sir.
Okay, so as much as this is great, if you have lots of deductions and allowances that you want to make use of, you can't make use of them if you're a micro business.
Yes.
Right, but then if you're earning a smaller amount in terms of, let's say 750,000 and above, okay, maybe you're earning $1 million a year, paying 3%, okay, on taxable turnover of 750,000, and then adding a minuscule 6,000 rand as tax is actually nothing. So you might have to weigh up the pros and the cons in terms of, well, do I really want to be classified as a business in terms of a company, or do I want to actually pay, or not pay, deduct my expenses, basically?
Yes, sir.
Okay. Alright, then the last bit we need to look at tonight in terms of theory is the interim payments. Okay, what is an interim payment? Have you heard of this before?
Yes, sir. Paying a bit of your tax I suppose during the year.
Why?
Before the Well, so that it's a little less, because your company makes so much money that paying it at the end of the year would just not not really make sense, but it would make SARS life a lot harder. So they need to have a constant flow of income, or rather of taxpayers' money within the year.
You're right. You're 100% correct. So in terms of the system, they work on a 6-month by 6-month system. So 6 months, you have to make a payment. 6 months, you have to make a payment. So the first payment is called the first provisional tax payment. Okay, and that takes place on the 31st of August. Well, prior to. It's due as the first payment on the 31st of August. Right, how is it calculated? It's worked out on your estimated taxable turnover, obviously times the applicable rate. So depending on whether you're an SBC, whether you're a company, it all depends. Your payment is going to vary and differ, obviously depending on what you're declaring, okay, your tax, your turnover. All right, but we'll look at that in terms of examples. Right, then you've got 28 or 29 Feb. That's the second provisional tax payment. Right, and the second provisional tax payment will basically be the tax that you pay over the whole year. Okay, so that part minus the tax that you would have paid over there, because that would have been the first payment. Do you agree?
Yes, sir.
That's why you less. Okay, so you never pay tax twice. You're only going to pay tax once. So on the 31st of August, you're going to be paying tax for that period.
Yes, sir.
As an estimate. And then when you reach 28, 29 Feb, you're then going to pay tax on that period, but taking the whole year into consideration.
Yes, sir.
Okay. Alright, how does a trust work? I haven't seen that many questions on trusts, looking at past papers. I've seen a lot of questions on SBCs, micro businesses, sole proprietors, but I've never really seen them ask too much about trusts. Right? It could probably be because trust is probably a separate topic and module on its own from a UNISA point of view in terms of examining a specific topic, okay, i.e. trusts and wills and estate planning and that type of thing. So I haven't seen much about this, just to give that to you up front, but not to say that it can't come up in tests and exams. Okay, so what do we get? We get two types of trusts, inter vivos and testamentary trusts. Inter vivos means you can create them while you're alive. Testamentary means those trusts are created when you die. Okay, so once you die, all your wealth and your savings and your investments would sit in a possible testamentary trust, and then that trust would operate and run kind of like a business and help support the wishes of the dying person.
Yes. Yes,
you get a trust deed and you get trustees. That's part of the process. If you want to create a trust, you need a trust deed. It's almost like a contract. And then your trustees are the person or persons, and they can be juristic or natural, but those persons are the ones that act as a trustee and manage the trust. Okay, separate legal entity, we've spoken about that before. Same thing applies to a trust. And a trust is definitely taxed separately, and beneficiaries receive the benefit. Okay, in terms of beneficiary, what does that mean? Well, if you had to die, and let's say you had to leave all your wealth to your loved ones, okay, the beneficiaries would be the ones receiving that benefit.
Yes, sir.
Okay. Alright, then I've just given you a note here about other taxpayers. There are special concessions for certain types of businesses, like farmers, like mining companies, like retirement funds. Okay, why do you think there'll be extra concessions for these types of businesses?
Because these are the businesses that basically are, like, I could say, the backbone of our economy.
Not really backbone, but these are the businesses that struggle or can struggle the most. Okay, because think about a farmer. When does a farmer get their income? Only when they're selling the crop.
Yes, sir.
Do you agree? And does crop grow overnight?
No, sir.
No, crop could take months to grow.
Yes.
Right, so what is the farmer going to do? Sit around and wait for income, and now if there's a drought, what happens? No income.
Yes, sir.
Alright, so these taxpayers have slightly different concessions. A concession means things that can help them survive and run.
Yes.
Okay. Provisional tax, we just spoke about it. You get first and you get second provisional tax payments. I've put this here because it's brilliant. Okay, I can't do better than what's in the study guide. The study guide's great for giving you information around how to calculate the provisional tax payments. Right, so I've literally taken this from the actual study guide and referenced it here. Please just look at it in your study guide. It's brilliant. The next one is the second tax provisional payment. Also brilliant. Everything's laid out nicely, easy to read, easy to understand. It's there. You just need to practice applying it. Right, so I'm going to look at the assignment just now and I'm going to apply it. I'm going to show you when I worked out the first and when I worked out the second provisional tax payment. Let's just finish off the rest of the theory. There is one other prov payment that you make at the end of. I think it's January if I'm not mistaken. No, it can't be, because the tax year, second prov payment is Feb, so I think the third would probably be before.
Wouldn't it be between January?
Perhaps.
Wouldn't it be,
sorry?
Wouldn't it be between January and the I suppose the end of the year?
The third payment.
Yes, sir.
The third payment. Because remember, the first payment, just to go back to this, first payment is on the 31st of August. Second payment is on the 28th of Feb. So it must be from March to somewhere. It's probably May or June, I think.
Okay.
Okay. Hopefully you don't end up with a third provisional tax payment, because that means that your calculation was slightly off. Okay, there's nothing wrong with getting the calculation slightly off, but if the calculation is completely different, let's say you were supposed to pay tax on 10 million, but you only paid tax on 1 million. You think SARS is going to want the extra 9?
No, sir.
Of course they do. They want the extra 9 million because you were supposed to pay tax on it.
Yes, sir. Sorry.
Okay, so the third provisional tax payment generally doesn't really come up because most people would probably comply with first payment and then second payment, and then in possibly unique situations or situations that don't occur often, would they possibly have to make a third payment. Right, if you've planned correctly and you've got your tax planning right, chances are you're probably not going to have to pay anything. Chances are you might even get something back from SARS in the form of a return, depending on how the business is structured. Okay, so just bear that in mind. There is a third provisional tax payment. This I haven't seen much in past papers. I have seen first provisional tax payment a lot. I have seen second provisional tax payment a lot. This one, not much at all. I can't actually recall a question where we actually looked at a third payment. Right, if there is one, you're going to have to help me find it because I don't recall one offhand. Okay, and there's the end of the theory. Great. So now we've wrapped up that. What I want to do now is just show you the application regarding these payments, these first and second provisional tax payments, based on what we covered last week in the assignment. Okay, just another note, Unam. Your
Yes, sir.
study guide, do I have that open? I think so. No, I don't. I don't have the study guide open. Okay, but anyway, let me just refer you to the study guide. Try, if you can, complete the sample exercises at the back of every chapter. Okay, right
Okay,
now
sir.
you've only done chapter 1 and chapter 2. Chapter 1 and chapter 2 are generally pure theory questions relating to multiple choice most of the time, and other
Yes,
questions to think about and consider. But moving forward, you are going to get more calculations as part of a longer question. So it is a
Yes,
good
sir.
idea to familiarize yourself with the examples in the study guide that Eunice has sent through to you.
Okay, sir.
I am going to ask you next week if you did have any problems with chapter 3's exercises, because chapter 3 exercises require a little bit of workings. Okay, but I'm going to
Okay.
describe that here when we look at some of these examples from the assignment last week. Okay, the first thing I want to look at is provisional tax payments. Okay, let me just go in order then. I'm just going to start with this. This was looking at an SBC. What qualifies as an SBC? Well, there were different options here that you had to consider in terms of a small business corporation. Right, and
Which
looking at the
doesn't
options here,
qualify.
there was gross income, there was Sophia, Zara, and Toyland were the only stakeholders in the CC. Okay, so obviously looking at this, Toyland was what? A juristic person.
Yes, sir.
Alright, so if they're a juristic person, if you look at the SBC requirements, you'll see that they actually talk about natural people there. Okay, I just want to
Yes.
bring this up. Okay, what question number was that? Question 15. 15's answer was 2 or 4. Okay, why 2 or 4? Well, 4 is looking at a shareholder. Okay, that's a problem. Right, what
Yes.
grounds doesn't Rent a Toy qualify? They don't qualify because
They
they're a
own
juristic
shares.
person.
Yes, sir.
Okay, and the other thing was Zara owned shares in a listed company. That was also something to consider.
Yes, sir.
Okay, which is problematic, and that's my only reason for going with those two. So a little bit of an ambiguous question here because 2 answers are actually correct. Right, so I'm not too sure which one you should choose. Okay, but I've described why I have gone with those 2 options. Okay, that was last week in terms of turnover. Qualifying turnover, we know it's $1 million. Oh, well, maybe you don't. Did I mention the million? I don't think I did, but as I said, with the turnover tax, there is a table that's in study unit 4 that provides you with that breakdown. Okay, so I might have remembered I might have forgotten to mention that, but I've remembered now. If you can, go back and look at the textbook, and very important, the announcements from UNISA, just in terms of approach, okay, and how you should be approaching your studies. Okay, remember assignments are they're quite short. I mean, the multiple choice one was probably the nicest of the assignments that you're going to have to do. The last one is a written assignment that you're going to have to present and create content for. Okay, the briefs are still being well, not briefs. The exam is still probably, well, actually, do you think the exam is set by now? Probably, hey? I think UNISA probably set them last year.
Yes, sir. I think so.
Does UNISA send you any additional briefs in terms of, like, I know with some of the other subjects, I know with accounting, UNISA tends to send them like a little bit of additional breakdown. Does the same thing happen in your other subjects?
Not so much. What they usually say to every time when I've always looked for, especially like hints for like their exams, they will just say study everything.
Really?
And everything
they
is
study everything?
Yep. They always say that there's no scope for the exam, and that every unit is equally important as. So I think what they're just trying to do is just trying to get everybody to just study everything in the sense of people knowing the rough breakdown of everything.
Yeah, sure.
Just so that they don't just know only the things that they are probably going to test. So
okay.
Usually that's what they always say, like, just study everything.
Yes. Okay, well, if that's the case, then maybe just study everything. But I just thought maybe they would send you something a little bit more helpful. But if that's not the case, then don't stress. I mean,
yes.
There's not a lot to study here. There aren't that many chapters, so it wouldn't make too much of a difference. But I just thought if there is that help, then great. If there isn't, then it's not a train smash. Okay. Right, here's one. 18. Kloof Cafe qualifies as a micro business. If it's a micro business, do I use 28%? Do I use turnover tax, or do I use SBC income tax?
If it's a micro business. Hello?
Yes, which one do I use?
Oh, you don't use 28%, you use
turnover tax.
Yes, so you use turnover tax. So.
Good. So let's go back to turnover tax. There's turnover tax. Right, what category am I falling under if I've earned, in the question, it had made taxable income and taxable turnover? Which one am I going to use, Unam?
You're looking at taxable turnover.
So which is that?
755,000 rand.
Good. And that's going to be taxed according to what?
It's going to be taxed according to the last one, which is 3%.
Exactly. But how does this work? It's this amount. So you have 6650 plus 3% of the amount above 750,000, which in this case was 5,000.
So wait, what do you do? You minus the
755,000, you minus 750, and you times that by 3%.
So you basically the percentage basically works on, I don't want to say the excess, but
it is the excess. It is 100% the excess, correct?
Okay.
It's the amount above, and then you have to add the base, because the 6,655 is the tax on all those other levels.
Yes, sir.
Basically, does that make sense?
Yes, sir, it does.
Okay, and then if you look at my answer here, where is it? This one, yeah. There's 18. Right, I got an amount of 6800. Do you see that?
Yes, sir.
Okay, so taxable turnover times, work out the difference, get the difference, add a 3% tax on it to get 150. 150 plus 6650 gave me the one option there. Got it?
Yes, sir.
Great. 19 was looking at turnover again, and here they were looking at first interim payment. Okay, that's important, because when you see interim payment, you should be thinking about what? Provisional payments.
Yes, sir.
Okay, so if it's a provisional payment, when is the provisional payment, the first one, made?
Before August, sir.
Yes, so on 31st of August would be possible in terms of an option. So we're either going to choose 1 or 2. Do you agree?
Yes, sir.
Okay, we just need to know how much tax do we pay. Alright, is this company a special company?
Yeah, well, it's a CC.
Yes, but
No.
does it pay tax according to a specific system?
Well, it pays tax according to the company's system, which
Turnover
is
tax.
yes, sir.
Okay, so turnover tax means we're going to be paying how much on 900,000? Can you work this one out quickly using this? I'll put up the table. Just work it out quickly on the calculator. I've done it already in the assignment, so I'm just going to show the answer, but I want you to quickly do it if you can. How would you work out the tax on it? So I did one earlier where you look at excess.
Well, there's a 6,650,000, and then I take the 900,000 minus 750,000, which is 150,000, times by 3%, which equals 4,500. So 4,500 plus by 6,650 equals 11,150.
Correct. That is option 2. Good.
Yes.
Alright, and remember the dates? The first provisional tax payment happens on the 31st of August. We saw that in the theory tonight.
Yes, sir.
Okay, this is just background in terms of theory regarding the micro business. You will see I give a bit more detail on the next set of notes, just regarding the micro business. It actually summarizes it there, so that you don't have to go and read too much of the legislation in order to get the right information. Okay, but just to give the theory answer to this one, 20's answer was option 2. This was looking at the 50% of all receipts of a capital nature from the disposable immovable property, okay, will not be included in taxable turnover. Right, so some things are included, some things aren't included. It all depends.
Yes, sir.
I want to get a one with companies. Yeah, here's a company one. Okay, so in this example, you've got a company wanting to pay tax. They want to know how much they're going to have to pay as a final tax liability. We spoke about the first and second provisional tax payments. Do you agree? That comes off what? The amount of tax that's owed to SARS.
Yes, sir.
Alright, so again, let me ask you this. What type of company? Normal company, SBC, or micro?
It's a small business, SPC.
No, it's not SBC. What did they say there on line number 2 or 3?
That it's not an SPC. Well, I think that then it's a normal company, so it's either a private or a public company.
Good. And how much do private and public companies get taxed?
28%.
Good. So what's 28% of the taxable income, which is 175?
28% of 175 is 49,000.
Okay, and then what are you going to do with that?
Well, 49,000. I'm assuming that the 49,000 is your tax liability. Then don't you divide it by what?
Did you add the other? Oh, hold on. Sorry, I'm thinking about the scales. Okay, that's my mistake. There was no scale here. So 29% of this was how much?
49.
Okay, so 49, and then you've made first and second provisional payments. So would you subtract that? Yes, you would.
Yes, sir. Yes, sir.
Okay, what number was that?
20, 21. Yes, sir.
Okay,
21,
21's
yes.
answer was 3. Yeah, 49,000 minus the prepayments. Prepayments are those payments that you make ahead of time. So your first and your
Yes,
second prepayments.
Yes, sir.
Got that?
Yes, sir.
Great. What is this looking at? Okay, this is looking at the first provisional tax payment. Okay, looking at Funky Nails, last assessment, with a taxable income of that. So when you are looking at prior years, so the current year is obviously 2018. Do you agree?
Yes, sir.
Right. And what are they trying to calculate here? They're trying to calculate the amount for the first provisional tax payment, which takes place in August.
Yes, sir.
Okay. So our job is to look at these numbers, taxable income, in line with the theory in the textbook. I think I put the theory in the textbook in the assignment pack. I hope I did. Let me just see. Yeah, C study unit 3. No. What number question was this?
22.
22. Okay, so yeah, so C, provisional tax payment. Okay, the reason why is if you look at your textbook, study unit 3, they talk about, let me open it and show you. Let's see, it's what book? First book? Which one would that be? Probably this one. Okay, yeah, this looks like it. Yeah, 95. Okay, chapter 3 is probably around page 40 or so. Yeah, micro businesses. Turnover tax. Okay, so now let me just show you this. Where is it? There's it. Okay, calculation of provisional tax payments. Right, they talk about the basic amount. Okay, the basic amount is applicable when looking at first and second tax payments. Okay, again, this is very detailed. I always refer to this every time I do a question like this in order to get the right answers. So, looking at this, Funky Nails' last assessment was 2015 with a taxable income of that. Taxable income submitted for 2016 and 17 was that. The company has a year end. Their first provisional tax payment for the 2018 year of assessment is due on 31st of June, of which amount must they base their first provisional tax payment. So if you're using different sets of information, okay, you are going to be using option 1, okay, 2 actually, right, which is this 920. Why? 920 was for the 2017 year of assessment, and your year of assessment is due on the 2018. Okay, in terms of that. Right, so there is a bit of a process that you need to go through just to get the right figure, right, the right amount that you're going to have to use as the base for the calculation. Once you've got that figure, then it's actually not too bad.
Yes,
is that
sir.
Right?
Yes, sir.
Okay. This is looking at who qualified. It's definitely the small business. I think we spoke about that last week as well. Let's see if we can find another one where there's a calculation. This one's looking at receipts from a sale of equipment. Okay, now we spoke about that. Let's do this one. SBC. Great. Okay, different example. An FBC, okay, company as an SBC for the year of assessment, 31st December, receipts of 1.3 mil. Okay, taxable income, 543,000. What is the tax liability of the company? What are we going to do? Are we going to use receipts or are we going to use taxable income?
Taxable income, sir.
Why?
Because it's a small business, it's an SPC.
Exactly.
And it's not on its sales. Yes, sir.
Exactly. Good. Okay, so go to SPC. Right, there's the SPC. We're going to be taxed in what brackets? How much did we earn?
We're going to be taxed in the final one with 3%.
543, this one.
540. Oh, yes.
SPC, be careful, not 3%. You said 3% there.
Yes.
That's micro business. Is this a micro business?
No, this is an SPC, sir.
Exactly. So, key in a question, make sure you read the question so carefully, because if you had used the micro business table, you would have got it wrong, even though you knew how to use the table.
Yes, sir.
Okay, so just be careful. If a business is an SPC, you use a completely separate table. And in this case, you can earn as little as or not earn, sorry, I said earn, you can pay as little as 0%, 7%,
Yes.
21%, or the highest, 28%.
Yes, sir.
Okay. Alright, let's go back. Then I'll work this out just to show you the working for it. Here's it. Where did I put it? There's it there. Tax according to SBC. Show the working. You get option 2. Alright, then there was a note here about prov payments. The last 3 questions here spoke about the provisional income tax payments. 2, 4, and 3 coming from the last bit over here. Right, provisional tax payments. There's the first one. Or second one. Can't remember now what the numbers were. But here's question 27. Okay, a company is not an SBC. If they're not an SBC, they must be a company or a micro business or a sole proprietor or a partnership. Do you agree a business is going to have to be one of those different forms of ownership? They just decide
Yes.
on which one they want.
Yes.
Okay. As long as they meet the requirements, they can fit in any category that they want. Got that?
Yes. Yes, sir.
Perfect. So now, if I'm looking at the provisional tax payments, this had to do with calculating the basic amount, which again is described word for word perfectly in the actual study guide in terms of taking prior year's amounts and moving it forward in time. And that's how you actually compound it a little bit in order to get an amount that would be applicable in today's terms. Right, so depending on what information you have available, you may or may not be able to tell SARS how much rates and taxes you are actually going to end up paying on let's say like a property or something similar. So what this does is that it allows you to identify what goes into actually calculating the base amount, and then that base amount is what you're then going to be utilizing in terms of that payment in terms of the tax brackets. Does that make sense? Yes, are you still okay?
Yes, I'm sorry.
Okay, so there's my example. Okay, basic amount, I wrote down 2017, amount is 1.2 million, at 28%, gave me 336,000. Divide by 2, gave me 168, which I chose option 2. Right, the next question said use an amount, okay, and then calculate the payment. This one. Right, what is the payment? Obviously applying the same facts in question 27, which we just looked at. Right, here you have to look at the amount. So what is the provisional tax amount that must be paid by the company on 31st of June? When do you pay? 31st of June.
Yes,
Right?
sir.
In the previous example, when did we pay? 31st of June. Do you see that?
Yes, sir.
Okay. Here they said, what is the provisional tax? Sorry, wrong one. Was that the right one? Yeah, it was the right one. Yeah, applying the sensitive information. What is the provisional tax amount that must be paid by the company? Okay, they're asking about provisional tax. So provisional tax means you need to calculate how much you're actually owing them because you have to make the payment before the year's end. Before the year's ended. Still okay?
Yes.
Alright, so if we look at the considerations here, what do I want to show you? I wanted to show you the prov payment. Was it provisional tax? Okay, yeah, that's fine. I don't actually need to show you that other diagram. We looked at it previously, so I think that's fine. Okay, just remember, prov payments occur where?
In the middle of the year. Or during the year.
Over the life of the year. So at some point in time, you might have over or underestimated the payments that you had made. Then you need to review and change them.
Yes.
Okay. Alright, then I think the next one was a repeat question. Yeah, second provisional tax payment, and then that's pretty much it. Right, Unam, so that's where I'm going to wrap up tonight. So at least we've gone through a little bit more of the examples in the assignment. If you have any questions, let me know and we can go through it in more detail. I've got the study guide open here. What I would suggest is you try go through all the sample exercises that they have in the actual assessment and then try look at the self-assessment questions. But if you find them too difficult, leave it, skip it, don't worry about it. We'll come back and we can look at them once you've got more knowledge and information. Right, because they do kind of jump quite quickly once they've looked at other areas. So for example, earlier we spoke about capital allowances. You haven't covered and learnt them yet. Earlier on we spoke about a wear and tear allowance. We haven't covered or spoken about that yet. Okay, so just keep an open mind in terms of not having covered all the information, but being able to do as much as possible currently with what we currently have in terms of self-assessment as well as textbook as well as notes.
Yes, sir.
Okay. Right then, so well done tonight. That was pretty much where I wanted to end off. That was it. We've covered all of this, and we've ended off with that discussion about the study guide exercises. Perfect. Do you have any last questions that you want to ask me, or are you good to wrap up and end?
No, I'm good. Thank you.
Great. Well done. Okay,
Yes.
then. That's it for this week.